But what I am saying is, if you have a long period ahead of you before you retire, you're a fool if you leave it in cash earning mediocre interest rates, which are way below the rate of inflation at the moment and probably will stay like that for a long time.
Wednesday, April 26, 2023, Monaco 64, home of alternative economics and contrarian views. I have the pleasure of speaking with Clive Thompson again today. Hi, Clive. How are you?
Good morning, Mario. I've just come back from Hong Kong, 2 weeks in Hong Kong. That has been a very interesting experience. It's 3 years since I was last there. And when I was there were thrusting bits of paper in my hand. There were demonstrations in the street. The bits of paper were about the anti-Chinese movement and the interference of the Chinese in the politics of Hong Kong. People were out in the streets everywhere. When I left Hong Kong 3 years ago, the airport was occupied. There were people sitting everywhere, thousands of people on the floor holding up banners. And this time, nobody even dares to open their mouth to discuss anything. They've passed a law called the National Security Law, which basically means that everybody potentially is a spy on everybody else. And there's a hotline they can call if you hear anybody doing anything or saying anything anti-Chinese. So people just won't open their mouths.
Yeah, maybe they're preparing for war because we're hearing so much going on geopolitically. I don't know. And I mean, yeah, the Chinese, they do censor, and you proved to me that through Hong Kong. But here in the West as well, we are relatively free. But sometimes if you say something that they don't like, you can get censored too. Look at what's his name, Tucker Carlson. He's gone from Fox News. But that's very interesting that because I have a viewer as well, subscriber. He's not Hong Kong Chinese, but he's going back to Canada. I think he's been there for many years, but he's moving his family back. So yeah, it looks like things are Hong Kong is becoming well, more and more like a communist China. But we wanted to talk today as well about what's going on. There's so much going on. Yesterday, I spoke about the debt ceiling, the impasse. We saw, I'll show you here. I think I sent you this as well, and I'll show it to the viewers. Let me just share it quickly. The credit default swap, as you can see on maybe you can explain to the viewers what this means, Clive?
Sure. So a credit default swap is a kind of insurance that you could buy against the default of a company or a nation going bankrupt or defaulting. It basically assumes that you'll get a 40% recovery rate. And when you think that a company might not pay its debts, you can buy this insurance against that. And the more likely it is that the company or the country will default, the more it's going to cost you for a credit default swap. And you can see on this chart, I can't actually see the numbers, but I recollect a few weeks ago, the cost of the credit default swaps were about 60 basis points before I went to Hong Kong. And it looks like it's up. Is it going up to 300 now or 250?
It's 140 now.
140, I can't see the numbers, but
yeah,
it's certainly a lot higher than it was a few weeks ago,
yeah.
Meaning the probability of a default by the USA is increasing. And as you displayed in the video, your video yesterday, Kevin McCarthy says that the left is not talking to the right about raising the debt ceiling. And if it doesn't get raised, we're going to default. And we've got a few weeks to go. I think it's 7 or 8 weeks to go, and they've run out of money.
Yeah, and we can see here that this credit default swap rate is gone above the one from 2011, which got up to 80. So this is serious, but apart from that, and if people want to find out more what's going on there, watch my video from yesterday. And I also heard from Rafi Faber. He wrote yesterday that the Republicans in Congress are supposed to pass their debt ceiling deal. It probably will go through, but Joe Biden's probably going to 99% sure he's going to veto it, or 100% sure that he's going to veto it. So the fact that they will pass something in the House is quite negative. It's the Republican plan. But Uh, so yeah, we've got the debt ceiling situation, but we got something else like coming back to the picture, and that's the banks and First Republic. And yesterday, I'm gonna share this with you guys too. First Republic, I think a couple of days ago, there's a lot of speculation that First Republic might do well, and people were buying shares in it. And then yesterday, I think it was Monday night, Monday evening, London time, they came out with their results. And yesterday, there was a sharp sell-off. The bank stock price dropped, it was already down 93%, as we can see here. And yesterday, it dropped another 49%. And it looks like 100 billion in deposits were withdrawn in the first quarter. And if people, maybe people remember, this is the bank where the big Wall Street banks about a month ago, when everything was hitting the fan, they put $30 billion into this bank. And now, as you can see here, government officials and regulators scrambled to come up with a plan to stabilize ailing lender. And this is another one of these banks that is there's a lot of high net worth individuals. It's a tech bank as well, a lot of technology companies. And yeah, it looks like they might bail out again the depositors here, all depositors. This is another bad precedent. Clive, what's your view on what's going on? Do you think the banking troubles are over?
Well, I have written that the next shoe to drop could well be the commercial real estate loans, particularly office space loans, where patently offices are worth half what they were before the pandemic, for lots of reasons. One of the main reasons being that low occupancy, but the other main reason being higher interest rates, which because most people buy these things with leverage. So at best, an office block is worth half what it was. And there'll be many people who, when they get to renew their leases, they won't be able to rent out so many floors. When they get to renew their loans, their fixed term loan, they'll be paying a much higher interest rate than before, and they won't be able to afford it. They're going to give the keys back to the bank. So those loans that the banks have made on commercial real estate, and I'm talking first and foremost office blocks, but it will spill over to all the related businesses. For example, the shops around the offices, which are selling the sandwiches to the office workers, the restaurants, and all the transportation, all the related businesses around there. There's less people in town. So commercial real estate is worth less, and the banks will be taking some losses on those. But that's perhaps not the biggest enemy of the banks. You know what the biggest enemy of the bank is, Mario? It's this. Your mouse. Now, money moves at the speed of light. Rumors move at the speed of light, and information moves at the speed of light. So it's not like 2008 when it took 9 or 10 days for Washington Mutual to lose 19 billion in deposits. When we had Silicon Valley Bank, they lost in the last day before they closed the doors, they lost 40 billion in a single day. And if they kept their door open another day, they'd have lost 100 billion the next day. That's the speed of light. So it doesn't actually matter anymore whether the story about the bank being in trouble is true or not. All that matters is whether people believe that it might be true. You can click your mouse and your money's gone. You don't have to get in the car, drive down to the bank and fill in a form for the cashier to wire money to another bank like you used to in 2008. Now it's the click of a mouse and it's gone. So the minute a rumor starts, you want to be sitting, like in the cinema, when someone shouts fire, you want to be close to the door. You want to get out of the door fast before everybody else, just in case it's true.
Well,
I think that's what's going on.
They might also block your access to your account, though, online, so that mouse. And the other thing as well, I would say, yeah, you take your funds out of Bank A and you move it very quickly to Bank B. But what if Bank B is in trouble? And I think there's only one way, personally. Yes, you need to keep some funds in the bank for bills and maybe taxes, but having it outside the bank, and that's getting harder as well. buying online, for example, gold or silver, they make a big deal out of it. Here, the banks say, "Oh, we're just protecting you against fraud and scams." But is that the same in Switzerland? Or is it easier right now to get out of the banking system altogether? And with that, maybe we could also talk about the study you did about gold and why it's better than because a lot of people say, oh, gold doesn't give you a return. It's a dead asset. Well, I would argue it's money, but you've gone further and you've looked at how gold is done and how you think it will do.
Okay, so two questions there. Is it like that in Switzerland where they're telling you can't take your money out? Absolutely not. I could use my cash card and take out 25,000 Swiss francs, for example, on my cash card alone, or I can walk to the counter if they have a counter. These days, it's a lot of ATMs, and ask the teller lady to give me that sort of money. Above a certain limit, I think it would be 50,000. She's going to ask me what I'm going to do with it. That's normal. And above 100,000, they want it to be electronic transfers. And I can walk into the gold and silver dealers and pay cash. Their limit, I think, is 10,000 Swiss francs, beyond which they want to know where you got the money from. And that's obviously not per transaction, that's cumulative. So if you go in 2 or 3 times and spend 3,000 or 4,000 a time, you get above the 10,000 limit. Then they say, okay, this is the 4th time you've been here. Tell us where you got the money from, give us your passport, proof of address, and evidence that the money's yours, which is easy enough to deal with. I'll just come back to the question of gold being a good asset for saving as opposed to money in the bank, because I got a call from my silver dealer yesterday. I've got a good relationship with him, and I encourage people to have a good relationship with their gold or silver dealers. But whenever he gets something interesting, he gives me a call, and I pop in to see what he's got, and usually I buy it. And yesterday he had 20 of these. I'll show you what they are. They are legal tender 20 Swiss franc coins. They're actually commemorative coins. They've got pictures on the back. This one's got barbed wire. It's a commemorative coin commemorating Gertrude Kunz, who was somebody who dealt with refugees in the Second World War. But 20 Swiss francs, legal tender. I paid 21. Why? Because it's made of solid silver. And to test this, I've only got 19 of these coins back now, but to test it, I walked into the bank across the road to see if they'd give me 20 francs in paper. So I handed this across to the girl behind the counter. It was a lady in her 50s or 60s, I'd say. She looked a bit startled because nobody in their right mind would hand in their silver for paper. But I was only going to lose 1 franc, and I wanted to test the system to see if it worked. So she said, "Are you sure?" And I said, "Yeah, give me 20 francs." And, right, here it is. I got my paper for my 20 francs. Now, I'd rather have kept that. But I think the important point is, if you can find something where you can buy it at a small premium to the silver price, go ahead and do it, because this effectively has given me a perpetual put on the value of money at 20 francs if silver goes to 0. But if silver goes to infinity, I'm a millionaire.
Yeah, and yesterday I went to the local pawn shop because up until 2 years ago, they never sold coins, gold or silver, but now they get a lot of silver coins from the head office. And I went to check, and it wasn't in the window. So I went in and asked, "Have you got any silver?" And they said, "Oh, we just got some." So I bought a few Britannias, and I asked, "Is there a lot of interest?" She said, "Yes. As you can see, it almost doesn't go to the window because people like you and a lot of others they want silver." So I think people are waking up to it. And I would say for people who have started stacking, buying silver or gold, not to wait until everything implodes, be it a banking collapse, be it a debt default by the US, because by then the banks are going to stop you from taking your funds out. I think do it while you still can, even if it doesn't happen. Maybe we can move on to the study you did, Clive.
Yeah.
How
So,
gold has been such a good store of value for your savings.
so one thing which I realize many people don't understand, even though you say it over and over again, Mario, is inflation is not the price of goods going up; it's the value of money going down. And we see that with gold. If back in the 1970s, £10,000 would have bought you 650 ounces of gold. By the 2000s, it would have bought you 65 ounces of gold, and now it will only buy you £10,000 will only buy you 6.5 ounces of gold. It's the pound which has gone down, not the gold price which has gone up. But obviously, technically, it has actually gone up. Over long periods of time, ever since the beginning of history, gold has kept pace with inflation in general. It'll buy you as many suits of clothes as the Romans could have bought when they invaded Britain in I don't know, it was 55 BC. They could have bought a toga with a gold coin, and today you could buy a fine suit with a gold coin. Things haven't changed much. I know a gold coin will probably buy me as many beers now as it did when I was born 66 years ago. Obviously, I couldn't buy beer then, but it's kept pace with inflation over long periods of time, and I'm expecting it to do so in the future. Of course, we'll have long-term fluctuations. We might have even a decade when it does nothing, and we might have a decade when it does 10 times what inflation is. But and we've gone through recently a very long period of when gold hasn't really performed. So it's really time for it to start performing again. Now, if you think about it and you put your money into a savings scheme for your retirement, let's say you earn 4 or 5%, and that's being generous these days, and it's in your own name, you're going to suffer income tax. Let's call it 40%, might be a different rate where you are. So you're going to end up with 2 or 3% after tax. Everybody knows that the rate of inflation in almost every country on the planet is higher than 2 or 3%. We know that food price inflation in the UK, what is it, Mary? It's 16 or 18% now, something very, very high. And the official consumer price index is probably about 6 or 8, and the retail price index is a bit higher than that. So what's happening is when you put your money into the bank, if you keep contributing to your fund each year, in the early years, your savings will be growing, and your buying power will be growing because you're putting new money into the fund. But after a certain number of years, your fund is sufficiently large that the inflation is eating into its buying power faster than you can contribute. So although the size of your fund, if you're saving in money terms, will be going up, your buying power after a period, as you get older, starts to go backwards. On the other hand, if you're saving in gold and you take a view that gold will perform in line with inflation, and I'm going to assume a straight line, that won't be the case, but if it performs in line with inflation in a straight line over the next 10, 20, 30 years before you retire, every time you contribute, your buying power will go up long after your buying power in a money fund has started to decline. So in simple English, let's say we have inflation going forwards of 8% long term. Every contribution you make in gold to your retirement fund will be increasing in value by 8% a year, whereas every contribution you make in cash to a money fund will be increasing by the 4% interest rate minus the tax, perhaps 2.5%. So you can see, and then of course that buying power is going backwards because of inflation in the money fund, whereas in the gold fund it's rising by that 8% inflation every year, if that is what the inflation rate will be. So I'm not suggesting anybody should put all their retirement savings into gold. You have to be diversified. But what I am saying is, if you have a long period ahead of you before you retire, you're a fool if you leave it in cash earning mediocre interest rates, which are way below the rate of inflation at the moment and probably will stay like that for a long time.
Yeah, and I guess in the UK you have things like ISAs, cash ISAs, but there's a limit that you can put there, like 20,000 a year. Some people might have more savings. The other thing I would say, there are some savings accounts that allow you, that give you like 4 or 5%, but I've looked into them and you can only put like a 3,000 a year or something. So I agree with you there. And the other thing about this depends on your jurisdiction, but here in the UK, if you have sovereigns or Britannia's gold and even silver, their capital gains tax free. So that's the other thing. There's no tax on it. But you said over the long term, and it's weird because people keep saying that gold doesn't. It's how can I say? Its quality of beating inflation has gone away. But if you look at from incrementum here in Liechtenstein, they always keep this scorecard since the year 2000. If we go into sterling here, we have had 10.8% per annum performance of gold. I mean, I would argue as well, because like you said, inflation is the currency being devalued, the currency value going down. It's just like issuing too much currency and credit and the economy not keeping up with it. Yeah, it loses its value. I would argue that we've been talking about the last 2 years how inflation's gone up, but I would say that we had already inflation since the year 2000, and the thing is, it did not translate too greatly into consumer prices, even though if you go back to 2000, you compare prices in 2015, yeah, the currency was going down. But look at that, 10.8%. I mean, I think the Swiss franc is probably the best performing one, but even then, the Swiss franc has dropped. Having gold in Switzerland has done a good job as well, as you can see here.
And there's no way I could have got 6.6% in a savings account.
Yeah, that's right. And what Clive, well, I think in Switzerland they had negative rates at one point. In Japan, we have negative rates still, and you're getting 10.3. That's the other thing. People keep saying, oh, there's deflation in Japan. But looking at this, it looks like the Japanese yen is being inflated away into worthlessness.
Moving on a little bit, you showed yesterday the Kevin McCarthy talking about how deeply in trouble the USA is at the moment with their overspending and their debt. Yeah, I think he sugarcoated it. I'm looking at the numbers from the Congressional Budget Office of the United States, which shows some different numbers from the ones he gave. He was talking about the total debt of the United States, but the relevant debt is the debt held by the public. That's the debt held by you and me, by your pension fund, by the government of China, as opposed to the debt held by the Federal Reserve, which is not the public. If you look at those numbers, I see on my screen that the current debt held by the public is 24 trillion. And under their own budget, the Congressional Budget Office, by 2033, that 24 trillion is going to go to 46 trillion.
Wow. So that's not even the total debt now. The total debt will probably go even higher then.
Yeah. So what they're proposing under their own budget is that the public, that's you and me, are going to more than double the amount of government bonds we hold in an environment where the interest rate on these bonds is way below the inflation rate. That isn't going to happen. The public are not going to buy another 22 trillion of US treasuries if the interest rate stays below the rate of inflation. It just won't happen. So, and also another thing to say about this budget, the budget consistently gets revised upwards. So if I look at the preliminary, they say here that the Congressional Budget Office's projection of the deficit for 2023 is now 0.4 trillion more than it was in May 2022. In other words, they keep increasing their projections of how much they're going to overspend. So that increase of 22 trillion over the next decade in the debt might turn out to be considerably greater if their budget exceeds the current expectations. And that's been the history, that budgets tend to spend more than they expected to spend. So
Yeah,
I
and
would say this is bad for the dollar.
yeah, the other debt that, the 32 trillion that we're almost up to, that includes the debt held by government agencies or the Federal Reserve. So that's probably going to go more to like 60 trillion, which is huge, over the next 10 years. And I think that's what even if Kevin McCarthy is able to do a deal and Joe Biden says, yeah, you're right, we need to cut this back, they're still not going to be able to cut anything back, in my opinion. And I think Joe Biden, he wants the debt ceiling increased, and that's it. No negotiation. He thinks trying to do something about this debt tsunami is not part of raising the debt ceiling. So this is getting very worrying. And yesterday, the UK, for example, they came out with their budget deficit for the fiscal year 22-23, and it was about 139.2 billion pounds. And I calculated GDP is like 2.2 trillion pounds. So that's 6.3% of GDP budget deficit. I remember the European Monetary Union, they had a rule that countries couldn't have more than 3% budget deficit. That was a real important rule. And here we are, supposedly in a economic environment that is not recessionary, and we're at 6.3% deficit. I think it's not just a U.S. problem, this growing debt. It's a Western Europe problem. It's a Japanese problem. So, Clive, to wrap up, can you maybe try to imagine what would happen and how long it would last if the U.S. Government, the U.S. Treasury, were to default? What would happen not just to the U.S. but to the whole world? And could that be the reason why we're seeing other countries trying to move away from the dollar so quickly, because they know this is coming?
We've never seen a default by a major Western economy in modern times. So we don't know what the consequences will be, but they will be very serious. If I imagine perhaps what I would describe as a worst case scenario, because it could be a lot better than this, we might find that the banks, you wake up one morning and your bank in the UK and France and Germany and Switzerland is closed because the US Treasury bill market is dysfunctional because of a technical default. And you might find the shop shelves are emptied the same day as people rush down because they don't know what's happening and they're just being cautious. It's like sitting next to the exit in a cinema when someone's calling fire. You don't know if it's a fire, but you're just making sure that you fill your larder quickly. That would be a worst case scenario. But if I sort of a little bit more optimistic, I think they will shut down the economy for a day or two, and they'll quickly vote to raise the debt ceiling, and they'll pay the arrears with interest for the 2 or 3 days. That's the best case scenario, and there will be no impact on the rest of the world. So somewhere between the two lies what might happen. If you're the cautious type and you think they get a default next week, make sure you've got some money in your pocket and make sure your larder is full.
Yeah, and maybe just cover a little bit Credit Suisse, because I think I don't think we speak. I don't think we spoke after it was. Well, I watched this press conference of the Swiss government, and I think it was on a Sunday, and they said, "Oh, this is not a bailout. This is just a transaction, a takeover by UBS of Credit Suisse." But we've learned, of course, that Credit Suisse would have probably gone under if it hadn't been for the Swiss government. So what's your feeling about what went on, and what is the mood in Switzerland? Do people care about it, the average person, or are things just back to normal?
Yes, the Swiss public care about it a lot because everybody was exposed to Credit Suisse in some way, mainly through their pension funds, because everybody's pension fund would have had shares in Credit Suisse. It wouldn't have been a big percentage, maybe less than 1%, but it's a loss to the pension fund nevertheless, and that needs to be recuperated over time on other things. Many Swiss individuals are investors, and they did have Credit Suisse shares. It was at one point, it was the blue chip of the Swiss economy. The share price was up in the hundreds. Now it's less than 1 franc. And so everywhere I go, I'm meeting people who've lost money, either privately on their own shareholding portfolio, or maybe they're less aware of it through their pension fund. So the Swiss public do care. UBS has brought in one of their old executives who sorted out the UBS mess after the financial crisis of 2008 to deal with the Credit Suisse and get rid of all the bad assets. That's his mandate. I think he'll work through that mandate. It might take a few years to do that. And by the time he's done it, I'm quite sure the Swiss government is going to require UBS to divest itself of Credit Suisse. Already, they're going to have to keep the brand name as Credit Suisse. They won't be able to call it UBS, I think. And I think they'll be forced to divest it. So I think we will, in a few years' time, maybe 5 years' time, end up with 2 large banks again. But it will be by then be a cleaned up Credit Suisse.
Yeah, and do you think there could be trouble again, maybe for UBS? We're seeing First Republican trouble, and how do you think it will impact also the currency? Because the government is supposed to back 100 billion, and the Swiss economy isn't that big. 100 billion is a lot.
The promise of a guarantee isn't actually pumping money into the economy at all. It's providing the reassurance that if something goes wrong, they will pump the money into the company. But the guarantee itself should be enough to stem the flow. But I come back to something I said earlier. The biggest enemy of any bank is the mouse. And all we need is some bad rumor to start developing and people be queuing up to take their money out and put it somewhere else.
Yeah, and then the Swiss government would have to pony up the 100 billion or more.
I've spoken with some Credit Suisse employees, and I have to say, I'm not Credit Suisse, UBS employees, and I have to say, internally, they're very optimistic about what's happened. They believe it's a good thing for them as employees and for the bank, but they would say so, wouldn't they?
That's right. That's right. So, Clive, maybe you can tell the viewers if they want to know a little bit more about you or what you write, where they can find you and your background. I'm sure a lot of people already know it, but some for the new viewers.
So I worked in the wealth management business for 47 years. I'm 66 years old now, and I've been retired for more than a year. But it's great fun to help people with their wealth, a bit like a doctor. When he retires, while he's working, he gets paid. When he stops working, he still goes to parties, and people come up to him and saying, Doctor, I've got this pain in my side. What shall I do? And you help. And I enjoy that. I like people contacting me to help them. I'm getting several approaches per day, and I'm obviously not going to tell you any specific investment advice, but I don't mind people bouncing their ideas off me and trying to guide them a little bit as to what they should be doing. LinkedIn is the only place people will find me. I write some articles every now and then on LinkedIn, and so far I'm succeeding in responding to the many messages I get every day via LinkedIn. Other ways like email don't work very well because I just get inundated by spam. At least LinkedIn weeds out most of the spam, and if you don't like somebody, you block them, and LinkedIn will ban them.
Yeah, and I guess our first interview was in November last year, and that was the first time you came on social media as well. And so we've had quite a few since then. I have a playlist for our interviews, and hopefully, Clive, we'll talk again in the future. I'm sure in these interesting times, there's a lot to talk about.
Thank you, Mario. Well, happy to help, and I'm delighted. I'd like to thank you for inviting me on your show. That's a great honor to be invited.
Thank you very much, and have a great day.
Thanks, Mario. Bye-bye now.